So for this last panel here, we have Romas Budd, the head of fixed income at Scotiabank Channel 1832. We have Dagmara Fijalkowski, I hope I said it right, head of global fixed income and currencies at RBC Global Asset Management. And we have Devlin, managing director at PIMCO. So because of, we had the luck of having the NAFTA resolved before this panel, I think I should start with that, with how you are positioning yourselves now that the NAFTA uncertainty has been lifted.
Well, we'll see. We're assuming it's going to get passed now. I've heard some rumblings today, I think, in the Senate that maybe it doesn't get done, but we're going under the assumption that it does get done. It's obviously a good thing for Canada. Generally speaking, I think that takes a lot of the uncertainty out of the market, in the economy and the market, especially in Ontario, which we were worried about the auto tariffs. So generally speaking, I think the Bank of Canada is now back on their hiking path, probably a little more aggressively than they would have been recently. I don't know how the other panelists feel about that. We haven't really talked about it a lot, but that's my view here. I think, for the way we are positioning, it's tough in fixed income right now, but we do see the next 50 basis points up rather than down. So that's kind of where our starting point is, and the USMCA just contributes to that feeling.
If you could talk a bit about the sectors you think could be winners or the credits. What are winners and what are losers in your opinion?
Yeah, I'm more of a macro investor. So the way we look at the world, like I said at the beginning, we're really playing defense rather than offense right now. So we are being very careful with clients' money here, whether it's on duration, whether it's on sector allocation, whether it's security selection. The valuations in Canada are not great. I mean, it's probably not what everyone wants to hear here, but maybe others feel differently, like I said. But generally speaking, we are going to look for better value points. And one of the keys is in Canada, 10-year government of Canada rate's like 245. In the US, we're like 305. And yet inflation rates are pretty similar. So there is risk in Canada on the rate side, and the valuation on spreads is also fairly tight. We don't think they're going to blow out or anything like that at this point, because we don't obviously we don't see a recession. But we do think there's pressure points, and you're just going to have to be a lot more selective on your sector allocation and your actual securities.
Do you agree, Dagmara?
Well, I'd say that first and foremost, it's nice to have NAFTA uncertainty out of the way. And when I think about NAFTA, I go back to what we do every day. And what we do every day is not trading, is investing. And for me, NAFTA is an event that potentially produces volatility that we can take advantage of. It doesn't change the way we invest. And if you think actually about this uncertainty being taken out of the market, where we are today versus assuming that it's going to get ratified, as Ramos mentioned, where we are today is maybe slightly on a margin worse off than we were with an old NAFTA. Shouldn't really change dramatically the way you invest for the long term. People were assuming that if NAFTA weren't ratified, auto, retail, transportation would be sectors that would be suffering. Perhaps they are on the margin, carrying less risk going forward. But again, for us, it's much more about what was our strategy for investing as opposed to trading the NAFTA headline, and perhaps using NAFTA headlines as if they contribute to volatility in the market as an opportunity to enter investments that we liked anyway.
Makes sense. What do you think?
So I would have a somewhat more caveated view on the NAFTA risk, in the sense that I'm not clear it's done. I mean, I think the U.S. politics with the lame duck Congress and then entering into the new cycle if the Democrats take the House, I'd say it's more likely than not. But I'd still say there's a fair bit of risk there that can get pushed, given the partisan kind of politics here in the United States. So that's the one thing I would say. The second thing I would agree that you want to be defensive in terms of your positioning on the yield curve. Canadian yield curve is exceptionally flat. You have almost no term premium, slightly inverted from 10s to 30s. So we kind of like the front end. We think this at the margin, the market, I think, reacted fairly rationally the other day, where the currency moved a little bit and rates moved 6 or 7 basis points. Currency was 1% or so. But that's not that doesn't tell you the NAFTA risk is out, is the way I look at it. And so in terms of your sectors, we still like financials, banks. You've gotten big capital buffers that have been built up. So kind of front end paper, 2-3 year, you can pick up Canadian banks or HSBC or some of the other Wells or some of these other Maple type paper by like 3% yields. And to us, playing defense now, getting kind of 3% and high quality credits that you're at the front end. We also kind of like autos, again, with the NAFTA risk that those are going to do well. So Ford and General Motors and BMW are all paper that we own here in Canada. And then we're pretty underweight the long end, specifically utilities. Those have been pretty tight for quite some period of time. Although the valuations to the U.S. have now, the U.S. came down so much, we actually moved. I manage our Canadian and some U.S. assets, so I moved my U.S. assets into Canada. And now I'm actually in the process of kind of unwinding that because now we're starting to see some value as you've seen the long end of the U.S. underperform.
Okay. And what are your thoughts on the future of the Canadian economy and how the Bank of Canada should react? I mean, how far do you think rates can go and how long do you think they could stay higher, whether if it's 6 months or 2 to 3 years? And how high can they get compared to the U.S. in your view?
Well, that's the big tough question, right? If I back up just for a second on that question, what concerns me a little bit is the central banks generally, and the Fed's the same way. They're kind of downplaying the inflation story. I'd say we're a little bit more concerned about that than the market is. If you look back, at least the history, let's say 10 years or so, the service side, you've had inflation pretty consistently. It's the good side that you've had deflation, and now you're disrupting supply chains. You've got tariffs that are going to raise prices. The service side, you're starting to feel the pressure on wages. There's a CFO survey just recently saying 4% wages. I'm kind of surprised central banks are not really talking about that a lot. We had Amazon today boosting some wages as well. So how far rates can go up, I think that changes over time, clearly. Like right now, the economy probably couldn't take more than about 50 to 100 basis points without some kind of backup in the financial markets and perhaps impacting the real economy. But in a year, if it continues to grow and inflation creeps up, that level of rates probably goes up as well. So it's this idea of the natural rate or the neutral rate can actually rise over time. That's kind of the camp we're in. So I'd say right now you could go up 50 without any real big issues, but to go higher, there has to be some time in between as well.
So due to your concerns with inflation, are you positioning yourself ahead of that? Are you concerned we might be heading into hyperinflation for Canada?
Right. No, well, we don't see a hyperinflation. We don't see like a 70s type of scenario. But what we are talking about is a risk of something that we're calling stagflation light. I think it's entirely possible. It's just, we just haven't been used to inflation creeping into that 3% level on the CPI basis anyway. I know the central banks use PC deflator, but let's say on CPI for a long time. So the valuations in Canada especially, like come back to what I said originally, at 245 on Government of Canada 10-year. As a taxpayer, I'm very happy they can borrow there, but as an investor and as a lender, I think we're just going to wait for better opportunities. And if we're right on inflation creeping up, I think we're going to see that.
Okay. And what are your views on rates and the economy?
Well, I think Canadian economy has done significantly better than was expected this year. I would say probably that we believe that some of that positive surprise was borrowed from the future. So we're looking at the long-term challenges to Canadian economy, what we call competitive wedges, and NAFTA or no NAFTA, they are still there. To give you just a few examples, when you look at direction of tax changes in Canada versus the US, whether this is corporate or personal, it's not advantageous to Canadian corporations. And also in terms of attracting talent, we're talking about this immigration dividend that Canada is supposed to be receiving. And yes, it's very true. I'm an example, although so much older than that. But on the other hand, I don't know how much of that we can pull from the US with so different personal tax rate. Another factor would be regulatory changes in terms of deregulation in the US and the regulation being from in various areas as strict or stricter as it was before in Canada. Costs for small businesses, when we talk about unit labor cost, whether adjusted for productivity or not, they are significantly higher in Canada. Even if you wanted one picture in terms of these long-term challenges, I look at the chart of investment in machinery and equipment and in intellectual property over the years. And since 2004, the wedge between Canada and US has been widening, significantly wider. In US, that investment is 10% of GDP. In Canada, 5% of GDP. That's a significant difference. So I look from this longer-term challenge perspective. I listened to Deputy Governor Caroline Wilkins on September 6th in Saskatchewan talking about challenges, long-term challenges to the economy, and I understand that the bank, for registering the positive surprises in the economic developments, they are also acknowledging that these challenges exist and they will be gradual in their hiking. Having said that, this is a window of opportunity to put these hikes in. The market has priced in 3 hikes by July, so October is pretty much now 95% or so. Let's say it's done. By January, we have another hike. By July, we have another hike. Let's hope that they can squeeze those in. But I don't think the Bank of Canada is worried about inflation, and I'm not worried about inflation either. The core measures are all around 2%.
Are you worried about inflation?
I just think inflation protection is underpriced in the market. So if you look at the break-even inflation rates, long-dated ones in Canada, 175, call it ballpark. That's significant. That's telling you 30 years you're going to be under the target by 25 basis points. Plus, it gives you no term premium for lending money for 30 years. So, we think that sector of the market's cheap. So we've got that trade on, and that's kind of protecting the long end a bit. The other thing I would say that is that we haven't really talked about from a big macro perspective is we just did a little study. 93% of all real GDP growth in Canada since the crisis has either been consumption or residential investment. So literally we've been a one-trick pony where consumers have been borrowing to consume or borrowing to invest in their house one way or the other. And we just, given the indebted levels that we have right now, we just think that, that pony we've been riding that pony too long. We've got to jump off and give it some water. And so the real question becomes can we rotate to an investment-led, export-led economy, and how is that rotation going to happen? Is it going to happen smoothly, or do we drop the baton for a little while in between? And I think we're just skeptical that it's going to go smoothly. So while the market's priced in 3 to 4 rate hikes in the front end, we think it's probably going to be a little more cautious than that. But we have to be cognizant that the output gap has been closed. Core inflation's at target, but I think given the balance of the risks and given the fact that the bank has also been running their core inflation below target for so long, it's not imprudent to let it run a little hot just to make sure that in fact that growth hands over. But we'd be a little skeptical of hitting the 2% growth numbers this year, next year, and the year after. We think we could miss that by call it 50 basis points or so.
Makes sense. And which parts of the fixed income space in Canada are more attractive to you right now, and which ones are you staying away from?
So basically, we hate 30-year nominal bonds, right? They are unattractive, relative to either real return. So instead of buying them, and they tend to be in some of our indices, we'd rather buy real return bonds. And instead of buying them, we'll buy bonds in the 2 to 5 year sector, and stay in very defensive, high-quality sectors. Whether that's provincials, banks, autos, a few other sectors, keep it tight. We're not lending money in terms of, we think the risk that spreads on corporates go wider is meaningful. And so we'd rather, when we're taking that corporate spread risk or default risk, we'd rather do that in the front of the yield curve. So we like the front of the yield curve, both from a capital preservation perspective, from a rates perspective, as well as on a credit spread perspective. So that's kind of where we're focused in terms of playing defense now to play offense later. I concur with the other panelists that do not think the bank is going to, this is going to run away from us. We're in a big bear market, but yields have gotten quite low. So I think this is probably the prudent place to be.
And how are you comparing corporate versus government? And I understand you prefer the shorter maturities, but do you also like other kinds of currency debt? Are you looking at this kind of things as well?
Currencies and things like that? Yeah.
Other currencies like bonds and other currencies?
Yeah, so what we do is, the way we run our portfolios, we run them kind of globally. And so we look around the world so we like European bank capital, not in Italy, but in places like the UK or Switzerland, where UK has been beaten up by Brexit, obviously, but they have the Bank of England there, or in some others. So you can get some spreads in Europe of like 400 or 500 basis points on their bank capital, where in Canada is half that. So we buy those and hedge them back to Canada. Emerging markets are starting to look a bit interesting. If NAFTA, the real better way in our view to play NAFTA was not so much Canada, it was Mexico. And so the Mexican currency looks, has been a good trade for a while. It's been a little volatile, but if you thought that NAFTA was going to resolve itself, it was Mexico that looked like the screaming buy to us. And Mexican rates at up around 8% or so also look like, maybe not today, but shortly they could be a pretty attractive area as well. There's just a lot of room for compression relative to developed market rates.
And Dagmara, what do you think are the most attractive trades in Canada fixed income now, and the least attractive?
Well, so unfortunately, if you only look at Canada, you can't say that anything is super attractive, right? And that's why I concur that it's very useful to have a look globally outside. If there is one significant force that we respect in the interest rate market, is the flattening of the curve. Ed mentioned that 20s, 30s are flat, 10s, 30s are flat now too, and inverted. And we're looking at this to be the most powerful driver. Investors anticipate the end of the hiking cycle eventually in the future, and don't see the risk about inflation running away. And we believe that that trend is going to continue. In Canadian IG space, even if you can't say that anything is super attractive, historically you didn't take a lot of risk, and you were compensated fairly for taking risk in short corporates in Canada. So we think that looking at that area and then applying our credit analysis to choose between both issuers and issues is worthwhile endeavor. And then amended with opportunities globally where they are more attractive.
Yes. What are your views on that, Romas?
Well, generally, getting to where the rubber meets the road for sure. This general idea of having the corporates in the front end, we're kind of there as well. It's a pretty traditional way of playing the fixed income markets in Canada. Our general risk level, adjusted for the weight that we have in corporates and duration, is below market, but not hugely so. Kind of lining up with what I said originally. I don't see the spreads really blowing out a lot, but they are tight. Same thing on provincials. They're going to be, their financing requirements are going to be quite large, and the Ontario government, specifically the biggest provincial borrower, the government is talking the right line, but I think some of the momentum there is in the wrong direction for a while on the supply side. So again, same thing in the provincials. We are under risked there as well. Internationally, the Scotia funds I'm responsible for are mostly domestic. I'm also responsible for dynamic funds. That's where we get into the unconstrained mandates. We do have some exposure, not a lot of foreign exposure right now because, of course, the rates mostly, like in Europe, are obviously very low. But we have some Australian, New Zealand exposure. We have some Mexican. It's fairly small. Most of it's been hedged back in Canadian dollars, but we're now starting to take some of those hedges off, especially in New Zealand and Australia, after this most recent little bump in the Canadian dollar. And also, perhaps feeding into the story, if EM does a little better and China does a little better, we'll see those currencies do a bit better as well.
And a lot of people are concerned about credit markets after many years of expensive monetary policy have pushed traditionally conservative investors into longer maturities and lower quality products. Are you watching closely to look for signs of potential deterioration in credit markets in Canada? Do you see any signs?
I'm going to let you guys go ahead on credit.
Yeah, I mean, I think the Canadian credit markets have traditionally been, fairly low beta, low default rates. So, we've often found a lot of opportunity adding value by investing outside of Canada for our Canadian investors and hedging it back. That being said, previous, I guess about a year or so ago, U.S. and European markets rallied so much and Canada didn't move that we moved back to Canada. And when we did move back, we moved back conservatively into liquid products that we knew we could trade and be, because we're active investors. We do move around. And so, we stayed again front end of the market and corporates, liquid paper like bank deposit notes or provincials or Canada Housing, even receiving on swaps. We'll do all those kinds of things. And so I think that now we've seen the sell-off in the U.S. There's some opportunities there selectively. One thing we like too in the U.S. is agency mortgages. If you look at how much spread you get per year of duration, it's quite high. So we actually have a number of U.S. agency mortgages hedged back into Canada, like Fannie 3.5s, 4s, those kinds of things. And in terms of Canada, it's I think that the key thing to really avoid in our residential uninsured residential mortgages, I think subordinated bank paper. If this consumer cycle comes to an end, this super cycle we've had for 10 years of never-ending borrowing and spending by the consumer, you got to look at those business models that get hit from that retail, subordinated lending, credit cards, subordinated credit cards, anything consumer linked is, certain REITs. Those would be the kinds of things that we would think are a bit stretched. Not saying they're going to blow up, but a bit stretched. And so we're definitely underweight those.
And what about you?
Well, what you're pointing out is that the long period of extremely easy monetary policy led to investors stretching for yield and potentially making unwise capital allocation decisions. And that's particularly reflected in some investors taking indiscriminate look at credit and buying the whole universe. ETFs is a particularly risky proposition, I think, at this stage in the cycle, in the credit cycle. I think that even though at the moment it looks like any credit is okay, it's actually at this time of the cycle when you are putting the seeds of the outperformance that happens during the periods of risk aversion. So we do actually make a significant use of our credit analysis. There are three particular reasons why we worry about this stage of the cycle in the credit market. One is that in Canada, like in the US, this period of risk appetite has contributed to significant growth in issuance of BBBs. In Canadian market, they are considering now 38%. In 2008, they were 17%. There is the other aspect is the fact that Canadian corporations are actually, yes, interest coverage ratios are fairly positive and profitability and revenue is attractive. But when you're looking at leverage is higher than average, and at this stage of a cycle, you would expect corporations to prepare for the time when they will not be able to service their debt with the generous cash flows that they're having. And what worries us is that we don't see that preparation evidence. So we're particularly choosy. Our credit team, for example, pays attention also to the change that is going to happen in Canadian bank debt. We are, over the next few years, the subordinated structured notes that were non-bail-inable will be now able to replaced with similar that can be bailed in. So that should lead also to potential risk in spreads, slightly pushing them upwards. All of these make us more intent on doing careful credit analysis than ever.
That makes sense.
Yeah, if I could jump in, I think I think that's a really important point too. Dagmara raises about the proportion of BBB within the indexes and how passive index investing looks different now than it did 20 years ago in Canada. Same thing on duration. The duration on the index has gone from like the mid 5s to mid 7s. So someone just buying a passive index fund or an passive ETF is now taking much more risk in fixed income than they did before. And on the issue of corporates, the only reason I kind of said to go there, I'm just not the corporate guy. We obviously have a credit team just like they do that digs into that detail. But what I will say is, just be aware that the risks have risen. The spreads aren't that great, but be selective. We saw a lot of issuers today, and they think all-in rates are pretty low still. But I think that's going to change. So there's going to be more differentiation of winners and losers, in my opinion.
That's great. Thank you, guys. We ran out of time. It was so quick. So thank you for being here.